Welcome to Lesson 21. This is the final video in the estate planning lesson. We will wrap up this lesson with a discussion of estate taxes and gifting. Much as we did with income taxes, we will go through estate taxes and how they are structured and how gifting is interrelated with estate taxes. The United States government has determined that taxing gifts, meaning the transfer of wealth between citizens, is socially responsible. The taxing of gifts and inheritance is based upon an integrated system. The three most important exceptions are gifts to spouses, the annual gift exclusion, and the lifetime taxable gift exclusion. The annual gift tax exclusion for 2013 is $14,000. This means that in 2013 you could give $14,000 to each of your children, or really anyone, without paying a penny in federal gift taxes. Your spouse could do the same thing. So combined, between two spouses, a married couple, they can give up to $28,000 to anyone, and in fact multiple people, without paying federal gift taxes. This is different than paying income tax. Keep in mind, gifts do not reduce income taxes. The gift must be a present gift. That means that the recipient must have unfettered access to the value of the gift. In other words, it cannot be conditioned on, I give you this and you must do that with it. Generally, the gift cannot be placed in a trust. It can be conditioned such that the recipient only has unfettered access for some reasonable period of time before it goes into trust. Gift to minors under the Uniform Gift to Minors Act, or UGMA or UTMA, can be in a trust and still be considered a gift. Gifts to 529 college savings plans are of course considered gifts as well. The lifetime gift exclusion is not really a tax exclusion, it's more of a tax deferral. Gifts that are not eligible for the annual gift tax exclusion and or amounts in excess of the annual exclusion are required to be reported on a gift return with the IRS. All such gifts will be integrated into the person's estate taxes. Under the exclusion, taxes on accumulated gifts up to the lifetime exclusionary amount will not be taxed until death. Once the exclusion is exceeded, gift taxes will be due in the year of the gift. Now let's examine estate taxes. Much like income taxes, which start at the broadest definition of income, estate taxes start with the broadest statement of the estate value. The gross estate includes everything in which the decedent has ownership. Thought of another way, it's everything that they could have controlled sufficiently on the day before their death that they would have otherwise given to someone. Thus, life insurance is included because they could have changed the beneficiary. Likewise, if they are the settlor of a revocable trust, they could have changed that trust. The gross estate gets adjusted for debts owed and for bills that come due after the person's actual death. Gross estate minuses debts owed minus debts owed minus final expenses minus expenses to prepare for estate taxation equals the adjusted gross estate. The adjusted gross estate is reduced by all available deductions. A married decedent can pass an unlimited portion of their estate to their spouse with no estate taxes. If an inheritance goes to a charity, it also reduces the value of the estate. This could be in the form of an outright gift or as part of a trust that somehow benefits a charity. Deductions include marital deductions and charitable deductions. All previous taxable gifts are added into the taxable estate to determine the basis for taxing the estate. The estate tax tables are progressive, much like income tax rates, only more aggressive. Similar to income taxes, estate taxes have credits in addition to deductions. The credits for estate tax exclusion deserve some special discussion. In the press, there is discussion of the estate tax exclusion being millions of dollars. It is portrayed as if it were a deduction from the estate value. This is not the case. In the code, that exclusion is transformed into a credit amount that is taken then against taxes owed. In contrast to a deduction that might possibly reduce the marginal tax rate on your estate, the highest marginal rate associated with the tax base will be applied to the estate. When calculating estate tax, you simply minus out credits that are provided by gift taxes that are already been paid, credits for the estate taxes that have already been paid, and of course credit for estate tax exclusion. This is how we arrive at the estate taxes that are ultimately owed.